Okay, welcome back everyone. We're just going to continue with our session on budgeting. And we're going to, in a little while, we're going to look at a video. Tom's going to take us through the Copland budgeting system step by step. But before we do, Eli and myself, we're just going to share just some things that we found helpful just in our approach to budgeting that hopefully you guys can incorporate. So a few of the things that I've just stand out for myself. When I think of budgeting, most people, again, don't get overly excited about budgeting, and understandably so, but you want to think about a budget as a financial plan, right? A financial plan to help you to achieve certain goals. So many of you may, in the future, want to purchase a home. It's really difficult to purchase a home these days without some sort of a plan to come up with a sizable down payment, right? And that's absolutely key. Especially with the way real estate's been going in the last 10, 15 years here in Ontario. Unless you really, are intentional about saving, it's not going to happen. It's going to be very, very, very difficult for people to purchase a home. But other things as well, such as children's education. We were just talking about this over lunch. It's important to start saving early for this kind of stuff, for retirement. It's better to start saving early, but you need a plan to do it. And even if it's a small amount each month, even if it's like $50, whatever you can afford, because it grows over time, right? If you think about it, and we talked about debt earlier and credit cards, how it can just be crippling, right? The interest that we pay. But on the other hand, when we actually can learn to start generating a surplus of cash and investing that money, whether it being for, retirement, education, for down payment on a house, that money grows as well, right? Because we invest it, so we get a return on that money. So it's important to start to do that gradually, because again, money doesn't grow overnight, it grows over time. We don't want to get, we're not looking to get rich quick, okay? The other point I just wanted to make for myself, these principles that we've been talking about today really give budgeting a real sense of purpose. Like, it's not just a practical exercise. Like, anybody can learn how to budget, right? You can go take a course anywhere. But if you don't understand these biblical principles, you're not going to be able, you're not going to have a long-lasting impact, because budgeting is, it's an exercise, but if you don't have the discipline, right, and the spiritual discernment how to make decisions with respect to your budget, then it doesn't really have a sense of purpose for a lot of people. They lose interest. Okay, so what I found is that if we stay connected to the Lord in prayer and ask for direction, and it's ongoing, right? It's like a living, breathing document. The majority of the work in preparing a budget is up front. It's just a matter of tracking your expenses. And like I said, maybe if you can go back 3 months or 6 months even and try and get an average of how much your monthly expenditures are, so you get a real sense of what you're spending. And then you take your after-tax income, and hopefully at that point you're generating a surplus, right, which you can use to pay down some debt. But without these spiritual kind of principles, it's really just a practical exercise. And I find, because before I took Tom's course 15 years ago, yes, I was an accountant and still am an accountant, and I did this kind of stuff, but I lost interest as well. I mean, it was just like, yeah, okay, fine, as long as, at a very high level, if I'm not getting into debt, I felt okay. But there's a lot more to it than that, right? We want to make sure that we're kind of managing, like I said, the money the Lord's entrusted to us, that's consistent with His will. So we need to know what the Lord's will is, and how to manage our money, and how to allocate the money. Third point, I would say credit cards. I know I've really hammered this point home, but credit cards, if we use them wisely, are a really beneficial tool when it comes to budgeting. So what I tend to do is, because most of us use credit cards, I actually put a lot of stuff on my credit cards. Because what I find is two things. One, it helps my budgeting, because at the end of the month I get a nice statement and it's got all of my expenses on it. But of course, I guess I should have said, make sure obviously that I have enough money to pay it off at the end of the month. I don't put stuff on there that I can't afford to pay. But if you do that, you get a nice statement at the end of the month, and it helps with your budgeting. You know where your money's gone, you can put it into your budget, and it kind of, makes it much more streamlined. Now, of course, there's going to be things outside of your credit cards, like if you pay rent, obviously, or if you have a mortgage and if you have property tax and stuff like that. But I just find that's helpful. And also, as most of you, everybody knows, these credit cards, you can get points and you can generally accumulate, whatever, some rewards and get some gift cards and stuff like that. So there are some benefits to it. So, again, just use them wisely, right? Put whatever that you can pay off at the end of the month on them. And it's a helpful tool just to help you track your expenses because they're not going away. One point I will make about credit cards, if you can, try to just have one, if at all possible. I get it. I know we have gas cards and we have Home Depot cards, and if you can get it down to one, that's ideal. If you need a couple, that's fine. But I've seen people with 5, 7 credit cards, and it's out of control, right? And it's like what they do is they borrow from one to pay the other. You don't want to go down that road, and it's also temptation, right? The more credit you have available to you, the more temptation there is to spend money. And that's what we don't want to do, especially when it comes to credit cards. Last thing I'll say about budgeting is just take your time. Initially, just take your time. Don't rush through it. Just make sure you gather all the information. That's the important part, right? Because if you don't have the proper information, you don't have a proper picture of where you are financially. You want to get all the financial facts so then you can start to make wise decisions, right? You can, if you've got a deficit, you got to get all your expenses in there so you can determine if you have a surplus or deficit. If you have a deficit, then you can start to figure out where you can start to reduce or even eliminate some expenses so you can start to generate a monthly surplus. Okay, so take your time. Once you get it established, then of course you just want to revisit it, whether it's every month or, I find the more you do it, like I'm at a point where I just kind of have I have a sense of what I can and cannot afford on a monthly basis. I don't have to look at my budget every month, but that takes time, right? It's over many years. But that will happen, right? Unless you have certain things that happen that are out of the ordinary, of course, you have to factor those in. But for the most part, once you understand what your monthly expenses are and you don't deviate from those much, you know whether you're making a surplus or a deficit. You know what you need to do. You know if you can afford something or if you cannot, right? Christmas is coming up, so that's something you want to kind of factor in, right? How much money do you want to spend on Christmas gifts? But for the most part, we should have monthly recurring expenses. And, like I always joke to my wife, in this country, it seems like I don't know what the big deal about Christmas is, because as far as I'm concerned, it's Christmas every month for people, right? Just go to the shopping mall and it's Christmas, right? Because that's what people believe Christmas is, unfortunately. Like, and we were talking about this over the lunch too. We were at Yorkdale Mall a couple of weeks ago, and it was just, it's insane. It's like not a healthy place to go. Anyway, so it was like, we're like early November, and you can't even find a parking spot. People, are already, gearing up for Christmas, I guess. So anyway, again, just take your time. The budget should be like a living, breathing document. Just, revisit it on a monthly basis or quarterly, whatever it is. If you're doing all right and you find things are kind of moving along as you've kind of projected, then that's great. You don't have to give it as much attention. But if you find you're not hitting the mark and you're starting to run a deficit still, then you got to give it the attention that it requires. Okay, so just those are just a few things. And one last thing, actually, I'll just mention. When you're doing your budgeting, and if you have to get to a point where you have to start cutting some expenses to generate that monthly surplus. Many years ago, when I worked in the banking industry, I had a client who gave me some wise information. He was I used to work in small business banking, so my clients were all entrepreneurs, self-employed people, and he said this. He goes, he did very well in real estate, and he said, the people who really get ahead financially, practically speaking, are the ones who not only learn to live within their means, but the ones who learn to live slightly below their means, right? That learn to sacrifice a little bit more for a certain period of time to generate that healthy surplus that can be used to quickly pay down debt, right? So you don't incur those interest costs. And then once you do that, Then you can start to take that money and invest it. And this is what this particular gentleman did. He invested it in real estate, and he did very well, right? But he sacrificed, and that's what he said. The people that learn how to live slightly below their means and sacrifice a little bit, they're the ones, and they invest their money wisely, they're the ones that are going to benefit in the long run. And again, needless to say, that's where contentment comes into play. I know we've been talking about that a lot today, but it is really important. So that's what I want to share. Eli, you have a few things you want to share with the group.
Okay, great. Thanks, Tony. Actually going to just move through a few of these slides. There aren't necessarily anything we're going to spend a lot of time on per se at this juncture. The objective is to develop and implement a budget, but we're just going to take a few minutes to help you appreciate it, impress upon you the value of this, because we do appreciate that this isn't for everybody. I'm sort of a financial geek. I have a financial planner mindset, and I enjoy doing this sort of thing, but I realize and appreciate that a lot of people, it's really not the case. So, our goal is to help you understand the value, why this is important. God admonishes us to plan ahead. Planning your finances can best be accomplished by using a budget, okay? And I'll just kind of walk through that a little bit. We've talked about this to ensure you have a surplus to save for future needs. That's how the last people in the case study were really able to do that. We've seen this verse already. By wisdom a house is built. I'll just read it again because it is important. Through understanding it is established. Through knowledge its rooms are filled with rare and beautiful treasures. Okay? Another one in Proverbs 27:23. Be sure you know the condition of your flocks. Give careful attention to your herds. So how do we do that practically, right? That's nice. That all sounds nice. And back when this was written, most people were farmers. They didn't have budgets and spreadsheets, but that's not really the case with us. We have a lot more. We have mortgage expenses, car expenses, a lot higher food expenses. So how do we deal with that? Okay. Yeah, the budgeting process, and I'm going to just touch on that word, the process, is a system that will provide the financial facts. Okay, and if you don't have a process, you're not basing decisions likely on facts. Okay, the facts, the numbers mean everything. What you think and feel are not going to override the facts. Okay, and especially if they are different, we need to go back to the facts. Okay, we already looked at this verse. It's Christ admonishing to plan ahead. The budget is a tool that does that, that helps us do that. Okay, so like I said, I realize it can be not everybody's cup of tea. It can be a chore for some people, and when I say it can be a chore, I don't mean just developing a budget. I mean consistently doing it or looking at or using it month after month, quarter after quarter, year after year. Okay, now you might get to a point where you have a fairly straightforward financial situation and you have a good feel and you're not noticing your credit card and your debts increasing, and that's great. And you have a good feel for things. But you need to understand that it's without a tool to track what you're doing, there's a reasonable chance, perhaps a relatively high chance, that your finances can go off the rails. So, for myself, I started building a budget. It wasn't the Copland budgeting system. It was before I met Tom, but I started building one nearly 20 years ago and kind of worked on that and kind of did it, sort of had annual, put in annual amounts of what I was spending and then try to bring that down to semi-annual, right? But I finally realized many years later that it was important to track things for me to stay on top of things monthly. And, I'm going to be honest, sometimes that was a little bit of a burden to try to stay on top of the expenses monthly. What I can tell you is, I've helped a few people with different budgets, so I've seen various scenarios. One I've seen, like for myself personally, and Tony alluded to this, having several credit cards. I've never had several credit cards. I've had two. The most I've had is two. Now I have one. But you need to understand, the more credit cards, the more bank accounts from which you are spending money is just going to make everything naturally harder to track. The more sources of places from which you are drawing money from is just going to be a lot more difficult to track. And I've looked at somebody's budget where there was 180 transactions, right, a month. For me, I've got sort of 70 to 80, 2 or 3 on average per day. You know, I've seen one that's double that, and I tried to help them, and it was, I was getting overwhelmed. And I enjoy this area of finances and tracking expenses, right? So you can imagine somebody that has 150, 180, 200 transactions a month. Sure, it's going to be a chore. Let's be honest here, right? So keep that in mind, right? Like if you've got multiple credit cards or bank accounts from which you're spending your money, just first things first, it's going to be harder to track. It's become more of a chore. You're less likely going to persevere and stick through it. But the key to this is perseverance, right? But I want to just kind of give you an analogy, because we just tell you, okay, budgeting's good, we should do it. It's a tool that helps track your finances. I'm not sure if that's going to give you all the motivation, but you think of it that the budget is a tool to help you get to where you want to go. And I heard a good analogy. It had nothing to do with this material, but it was a presentation at work, and I kind of tweak it to fit this. I mean, he mentioned GPS, right? We all know, and perhaps a lot of us use GPS. And GPS can be used as an acronym. You know, the G is goals. We all have goals, okay? Financial goals. Even if somebody here is saying, no, I don't really have any goals. Do you want to ensure you don't outlive your money? Sure, that's a goal. Nobody wants to outlive their money, okay? Do you want to make sure you can make your mortgage payments over the next 1, 2, 3, 5, 10 years? That's a goal, okay? Do you want to make sure you can get your next vehicle whenever that's necessary in the next 5, 10 years, whenever the case is, or sooner? That's a goal. So we all have goals, okay? We are faced with problems, the P, in getting those goals. We have high inflation. Prices keep increasing every month, right? It's way out of control compared to how it was before. We have higher interest rates and higher mortgage payments. How do we deal with that? And we want to, have something to help us get to the solution, the G, the P, the S. I'd say, the budget is part of a process. You have financial goals, whether you realize it or not. Probably most of you do realize it, but these are really, really important. You need something to help you achieve that. And the budget can be the short-term tool that helps you do that. It's helped me greatly over the years. I mean, there's been a few months where I admittedly found it a chore to maintain it, and just didn't feel like doing it. Preferred to do other things, enjoy the summer and do other stuff, other activities, and didn't really want to spend the time. But as I got back to doing it, it gave me more of a sense of comfort and peace that I was able to properly track my finances, gain the wisdom and understanding that God wants me to have in this area. So I just encourage you. I mean, we have our own budgets, and many of you might have your own that you've started and maintain. If you're growing weary of trying to maintain it, just remember it's something that can greatly help you achieve your longer-term goals. A shorter-term tool that will greatly help you with your longer-term goals. Okay. So again, we go back to this Luke 14. I will read it because it's a recommended memory verse. Suppose one of you wants to build a tower, will he not first sit down and estimate the cost to see if he has enough money to complete it? For if he lays a foundation and is not able to finish it, everyone who sees it will ridicule him, saying, 'This fellow began to build and was not able to finish.'" Okay, so if you don't have a budget, you have nothing, we encourage you to start doing that. If you have one and you feel it's effective, keep maintaining it, keep using it. It will greatly help you, even if it just doesn't always seem appealing to spend time on. And what we want to do is there's always, invariably, a few people that just have no idea how to kind of get started in this area. The Copland budgeting system is an excellent tool. There's really none better than Tom that can actually explain some of the key ins and outs of this. We want to just spend a bit of time looking at this. This is an instructional video. There's several small, shorter video clips that kind of goes through the different forms of the Copland budgeting system. We definitely encourage anybody who has if you have no system at all, this is a great tool. It's free. And we want to just play a few of these videos to help us understand, because we really think this is an important point for people to get. And if nobody's ever done this, we don't want you to leave feeling overwhelmed and I can't do it, right? This is available. Us at the ministry, Tom, we're available to guide and assist if necessary, but we don't want anybody to leave here feeling, I can't do it, I don't understand it, so I'm not going to bother. That's definitely the last thing we want. So we are going to look at the Copland budgeting system. Let's see if I can get this to work.
Forms, and I'm going to give you a quick overview of each form and how they work, and then come back and provide the details. Form number 1 provides a list of simply your assets and liabilities. Form number 2 is where you indicate what your salaries, wages, and other income is, and you put your salaries and wages net of your taxes. Form number 3 is the non-monthly expense planning form, where you key in the annual costs and then it's automatically calculated on a monthly basis. You need to keep track of these so you can provide for them. Form number 4 is a savings account allocation, so that when you do set aside money for savings, if it's designated for a future expense, you'll know what it's there for. Form number 5 is your estimated monthly budget, which provides an overview of all of the expenses that you anticipate you're going to be incur on a monthly basis. This is an important form, as it shows, perhaps more importantly than anything else, whether you have a monthly surplus or deficit. Form number 6 is the form that you're going to use almost on a daily or perhaps every 2 or 3 days, where you start tracking your expenditures. And I'll provide the details later, but it's an important form. Form number 7 is one where you don't actually have to put anything on. It's automatically calculated. The figures from your present budget from form number 5 end up in the first column, and the figures in terms of your actual expenses for a month from form number 6 end up in the second column. And then it actually compares your actual expenses to your budgeted amounts, and it shows where you're over budget or under budget on different expenses.
We lose power or something?
Here's my detailed explanation of form number 1. On this form, what's critical is to list the assets and liabilities. As the proverb says, know well the condition of your herds and flocks and grains. We don't have herds and flocks and grains today, because most of us at least aren't farmers. But we do need to know well, we need to understand what our different assets and liabilities are. So I'm going to put in some sample numbers. So for this couple, I'm going to assume that they have $1,000 in the bank. I'm also going to assume that they have investments, perhaps in a mutual fund or something, of $10,000. In terms of their principal residence, they estimate that the fair market value of their principal residence is $350,000. In terms of their pension plan, their RSPs, the husband has about $40,000 in his, and the wife has about $10,000 in hers. We now go to the liability side. And by the way, you should list any other assets. This is sort of for those other types of assets that could be sold and generated some cash. Do not list anything of a personal nature that you would never ever sell or couldn't be sold. But often if people go and look at their basement, they could have stuff in their basement, things that are valuable to other people that they could sell through a garage sale or through the internet or whatever, and you would list those there. And if you do have something, let's suppose this couple does go into their basement and they figure out they have $5,000 worth, so we're going to put that in there. Next, we'd like to list their liabilities. And the first line is their credit cards, and this couple are doing what most people are doing. They're running up their credit cards, and they owe $25,000. In terms of personal loans, they have loans that they owe to family members of $30,000. In terms of some of their other debts, they have a personal line of credit on their home of $60,000. They've done what a lot of people do. They've basically done some bill consolidation loans where they've taken out a personal line of credit in order to pay down their credit cards. Because if they look at their finances over the last couple of years, they've been spending a little more than they've been making on a regular basis, which is so common. In terms of the mortgage on their principal residence, we're going to assume that that's $200,000. And you can see the total here. By the way, you should watch for other types of debts. For example, there could be things like property taxes overdue. There could be things like dental bills or any other types. And we're going to assume that they have $10,000 of some of those other costs. So you can see the total liabilities that this couple has is $325,000. And their net worth on their personal balance sheet here is $91,000, which on the surface looks not too bad. But in actual fact, when we get into some of the other forms, you'll see that they have been spending more than they're making on a monthly basis, and that's why they're running up the credit cards, and that's why they have the personal loans and the personal line of credit.
I just want to make a quick comment on that net worth. I sometimes hear quite a lot. Oh, my home's worth $500,000, $1 million, whatever, right? And okay, I have a mortgage of $500,000, but that's all looks nice on paper. For me, that is, to be quite honest, quite irrelevant unless one of two things are going to happen. You're willing to significantly downside, and that's a very realistic possibility, or you're willing to move somewhere very, very far and remote where the cost of living is much lower. If neither of those things are very realistic, I don't think that presents a very realistic short-term evaluation of one's financial position. When somebody just, I've got $500,000 or a couple $100,000 net worth in my house, because we have to factor in we all need somewhere to live. And if we're willing to live in a box, okay, that's fine. But if we need to maintain our lifestyle in our house and our dwelling, then I don't see that as something that's going to assist us financially, at least in the short term. So just something to keep in mind. It's something I hear a lot, like my house, my property is worth X or Y, and so it's no big deal that I've got hundreds of thousands of dollars of debt. So just keep that in mind.
On form number 2, you essentially list the revenues or the income that you have for a typical month. So let's suppose that the husband's wages, net of his withholdings, again, put in net of with his holdings, is $4,000 a month. And let's suppose that the wife works part-time. She earns $1,000 a month. And let's suppose they have a little bit of investment income, maybe $100 a month. And then they have other miscellaneous income, can be like a child tax benefit or something like that of $200 a month. So I think you can see this form is very simple, very straightforward. You just list all the sources of income on a monthly basis. And as you can see, we've got formulas in this Excel template that total up the total revenue for a month. And you'll see at a later date that this total revenue does show up on form number 5. And also please note that it's important to, I would round everything to the nearest dollar. You don't need to put in pennies. It'll make it a whole lot faster.
This next one is very important. It's critical, so let's see what that shows.
Form number 3 is the non-monthly expense planning. This form is really important. Often when individuals or couples prepare their own budget, they will forget about their non-monthly expenses. And you can see some sample non-monthly expenses here. You'll notice that it's important to key in an estimate for the year. Wherever the yellow shading is, you should key that in. For example, house maintenance. This couple is estimating based on prior years that their house maintenance for a typical year would be $1,200 a year. And as you can see, it automatically does the calculation and it shows up as $100 a month. Property taxes, they know that last year their property taxes was $3,300, so they're going to key that number in. And again, you can see that works out to a cost of $275 a month. Now, by the way, if your property taxes is included in the payment of your mortgage on a monthly basis, you don't have to put anything there. House insurance, normally it's paid once a year, and last year it was about $600, so that's their estimate. Automobile replacement, it is important to save for your next automobile. This couple is not going to put any money in there because they don't have it. They are running a deficit on a monthly basis, but they should ideally, once they get their monthly cash flow under control, be setting aside some funds on a monthly basis for their next automobile. Automobile repairs and maintenance. This couple estimates, based on prior years, they have 2 cars, $2,400 a year. Some people will say to me, and as you can see, that works out to $200 a month that they need to set aside for auto repairs. Some will say, well, we don't know what that's going to be, and that's true. But if you, just a rule of thumb, if you allow about $1,200 per year per car, you'll probably cover off most of your automobile repairs. There will be exceptions, but you'll probably cover off most of them. And even if you ran over that, at least you would have some money available. Auto insurance, it's anticipated their auto insurance next year will be about $2,000. So they key that in. And again, it calculates $167 a month. Vacation, this couple plans to take a vacation next year, and they estimate the cost of that will be $1,800 for next year. And by doing this, by saving $150 a month, when it comes to next year's vacation, they'll have the cash available, and they won't do what most people do, that is put it on the credit card and get into debt. Investments for their pension plan, they should be putting aside some money for that on a monthly basis. This couple's not doing that because they are in debt and they do have a negative monthly cash flow, but once they get their finances in order, they should do that. Healthcare expenses, they estimate it could run $1,500 a year based on prior years. Again, it's only an estimate. If you have children that need braces or something, that obviously is going to be a lot more, but they're going to put through the $1,500 a year. Christmas gifts, they estimate that they're going to spend about $900 on Christmas and birthdays in an average year, and they key that number in, it works out to $75 a month. Other is the miscellaneous category that doesn't cover anything else, and often people will say to me, well, $50, $100 a month. Not true. Often $3,600 a year or $300 a month would be quite typical for the average couple. What's important about this form is that you can see the non-monthly expenses add up to a total here of $1,442 a month. And that means every month they need to set aside that money to save for these expenses so that when these expenses come due, they have the cash and they're not forced into debt. As you can see, you should prepare this form initially and revise it only when there are changes in future. So this is not a form that you have to do every month.
So I just wanted to share a few comments with respect to the non-monthly expenses. That something that I find helpful is, if at all possible, for some of these items, for like the insurance, the investments, and property tax, depending on which municipality you live in, you can pay these monthly, right? And this helps to streamline your cash flow. So this way you don't have to save separately for them, if you pay them once a year. That's what I found helpful. If you can pay your insurance on a monthly basis, and your property tax on a monthly. Some of them do it over 10 months. Again, it depends on where you live. And definitely with your investments. Like investments, it's important. You wanna try and just, allocate, whether it's $50 or $100, whatever you can afford per month. It can just come out of your account directly and go into whatever investment you set up with your, whatever institution you have your investments with. But I just find it really helps to streamline your cash flow, and then you don't have to think about it, right? You don't have to think about saving for them and setting the money aside every month. It just comes out of your account automatically. You obviously have to make sure that you have that money set aside there, but then it's just a few less things that you need to worry about, like these other items that we've talked about. They're like healthcare and Christmas gifts. Those you have to kind of just set money aside and use them when it's required. So.
Yeah, I also just want to see if there's something here. Yeah, I don't know. Let's see if we can. Sorry, should have had this. Let's get that bigger. Okay, so I'm just going to highlight one thing here. This is crucial. A lot of people can miss stuff like this, and that's where things go off the rails. You can see this list somewhat long. When we look at the top versus the bottom, there's sort of a bit of a gap between what's more discretionary and what's less discretionary. This one for me, this hits home, like this house maintenance. I think we were talking to a couple in the break there, but I was thinking, like, when I set out to buy a house, my 20s, I didn't really. I remember getting some advice, like, just be prepared. There's a lot of dollars that can go out the window, literally. I didn't think about things like, okay, the roof, yeah, I kind of get it. Windows, tens of thousands of dollars, and yeah, they're not going to last forever. So there's things that are kind of more obvious, and then things that are less obvious. And for somebody like me, like a finance geek, and doesn't really understand home building and home structures and things like that, like there's a bit of an education involved. And it's funny, I got a letter a few weeks back from the city, I think it was the city of Whitby, where I live, and I didn't really understand it at first, saying, please, note, I forget the wording exactly, but, the pipes that come from, I guess, the water, sewage drainage from your house that go down to the street or whatever, that place, they are your responsibilities. Of the underground pipes off your property onto the road or wherever it leaves there, and if they freeze and geez, that's okay. I guess I'm going to be on the hook for that. I didn't realize that. You just kind of assume you don't know what you don't know, and you kind of think, okay, well, maybe that's somebody else's expense, right? But point being that there's just a lot of stuff in here in this bucket number 1 that could creep up at any time. Now, I haven't had any issues with my pipes, but that's something that was never on the brain for years, right? That could be something that could come up. My focus on the roof and the windows and other things in the interior, right? Or maybe just right on my property outside, or maybe my driveway, right? So I would highly encourage you, set aside anything you can here, some sort of assumption, and don't wait till the end of the year to allocate money to home maintenance savings. You want to be able to do that regularly. It is critical and vital, because something almost always will come up, and it could come up when you least expect it. So you want to have something here to meet some unexpected expense requirements. So we'll go to the next video.
This is form number 4, the savings account allocations. The purpose of this form is that when you do save a certain amount each month for the various categories, it automatically allocates the amounts over here across the top to each category. And the whole purpose, by the way, is so that if you have money in your savings account, you can determine how much money is designated for future needs and how much would be surplus funds. And so here's how it works. If you go to form number 3 for a minute, you'll see on form number 3 that we calculated certain non-monthly expenses. For example, house maintenance was $1,200 per year, and it works out to about $100 per month. Or property taxes works out to $275 per month. If we go to form number 4, you'll see that these amounts automatically show up here. And as a matter of fact, if you follow it through, all of the other amounts that are calculated on form number 3, these amounts that are showing in this column here, right down to the $300 for others, they're showing over here on form number 4. And the idea here is, again, to know how much money you need to have in your savings account for future expenses. Now, one of the practical aspects is, of course, you can have all these allocations on an accounting basis in your savings account, but you got to actually put some money there. So what you do there is you go to form number 6, and in form number 6, you have to record the revenue. Now, we're going to assume that this couple gets their revenue once a month. If it's twice a month or 4 times a month for you, you would key it in independently. But I'm assuming once a month they get their full $5,300. And then what they would do immediately is they would transfer $1,442. That was the total amount at the bottom of form number 3. They would transfer that to their savings account to cover the non-monthly expenses. And you can see I keyed the $1,442 in there. So if you go back to form number 4, you will see the $1,442 shows up as a receipt from the checking account. There it is. And you can see that we actually have a balance in the account of $1,442. Now, the main purpose of this form is what's shown at the bottom here. We have funds in the savings account of $1,442, designated funds for future expenses of $1,442. So that means the undesignated funds is only is 0 in this case. What that does is it prevents the couple. Often I see couples or individuals will say, hey, can we afford that new TV that's $1,000? And they'll say, well, sure we can. We have $1,442 in our savings account, when in fact they cannot afford to buy it because those funds in their savings account are designated for future expenses. And since they have no funds available, they have no undesignated funds, they should not go out and make that expenditures. All their savings effectively is accounted for. It's designated for future purposes. And that's the main purpose of keeping track of form number 4 in all these various expenses in your savings account. This is form number 5, which is the estimated monthly budget. This is the form that sort of ties a lot of things together, shows you your expenses, including the different types of expenses, and you'll see we'll come down and we'll determine if there's a monthly surplus or a deficit. For this particular couple, they're giving about $100 a month to the Lord's work. Their mortgage of $1,013 is what they pay on a monthly basis. Their electricity bill is averaging about $275 per month. Their gas bill is $225 per month on average. Their water and sewage is about $100 per month. Their telephone is about $300 per month. Now, this includes other things like internet connection as well as cable TV and that kind of stuff. Now, you'll notice what I'm doing here is filling in those boxes that are yellow. There's some numbers that are here already, and these figures came from form number 3. For example, the property taxes of $275, that was calculated over here on form number 3, and it automatically gets transferred to form number 5. And you'll see there's other numbers here that I did not have to put in that came from form number 3 as well. The maintenance of $100, the insurance of $50, the insurance on the automobile $167, car maintenance, etc., and several others on this side, vacation, as well as health care, gifts, and others. So those automatically flip over from form number 3 into form number 5. But there are some expenses, and these are the ones, again, that are marked with yellow. Some of those categories have to be filled in. And by the way, if you don't have the exact number, don't worry. At least give it your best estimate, perhaps allow a bit of a cushion. For this couple, they looked at their food bills over the last several months, and they have two teenage boys, so they're spending more than normal, $800 a month. Automobile replacement, that was calculated on Form 3. Remember, they should be saving for their next automobile, but they're not doing that. Gas and oil, they do have 2 cars, and right now they're spending about $300 per month. On their credit cards, they're only paying the minimum payment each month, which is not good, but that's all they're doing. That's $500 per month. And on their personal line of credit, they're just paying interest, and that works out to about $210 per month. If you now go up to the other side, eating out, they spend on average $250 per month. Their vacation's $150 per month. That comes from our calculation on form number 3 of $1,800 divided by 12. Their sports, gym, that kind of stuff, they spend about $100 per month. On clothing, they're incurring about $200 per month. And insurance, these are things like life and disability insurance. That's being taken out of their bank account on a monthly basis. It's about $100 per month. And for education for their children, just miscellaneous education costs, books, etc., they spend about $100 per month. So what you can see this form is, once you completed everything here, you can see their total expenses for a typical month is $6,015, while their total revenues, which comes from form number 2, is only $5,300. So if they did include all of their non-monthly expenses that we've included, they end up with a monthly deficit of $715 a month. And this is very typical of what we see with most individuals and couples. That is, they're spending a little more than they're making, typically using credit cards or personal lines of credit in order to finance it, and as a result, they're accumulating debt and they're incurring a monthly deficit. And this is one of the first things that they have to deal with. And often what I'll suggest at this point to whoever we're working with, that they go through some of these expense categories and decide together what expenses they could lower in order to try to balance this somehow. They have to make sure that they're spending less than they're earning, so they have a surplus here, so they have some money available on a monthly basis to pay down debt rather than spending more than they're making and accumulating debt.
So this Form 5 or Form 6 that's coming up, this is also extremely important, because I think a lot of people will try to do this, but maybe not necessarily persevere in the tracking, properly tracking, accurately tracking your expenses. Now, Tom has a form that can do this. I've heard, our pastors has mentioned, there's a lot of apps, and maybe you know of some that can do this, and it doesn't have to be a really huge burden or chore. I mean, for me personally, I just download stuff from my bank and copy and paste in Excel, and I do everything online, and it's a bit streamlined that way. But I remember somebody I knew years ago started trying to take hard copy receipts and was doing stuff manually, pen and paper, and I was just getting tired. I was watching it like that'll make you not want to do it, right? So if you can find some sort of effective way to track the expenses as accurately as possible, we don't have to get down to the dollar, but you can get to the point where you can allocate everything to something. That is really, really helpful. And if you can do that, if you're just getting going, you've never done this before, do it for 2-3 months to really get a good picture. And so this next form, I think, will be an option that you could use to do that.
This is form number 6. This is the form that allows you to track your expenditures by the various categories on a regular basis. And I usually recommend to individuals that they update this form every day or perhaps every 3 or 4 days and keep track of it. I also usually suggest that if you're married, to have one checking account and one savings account, have one joint checking account, and have all your expenditures go through this one joint checking account. And if you do use a credit card, pay them off each month, and as you pay them, record the expenses to the various expenses as shown here. So I'm going to just give a few examples in terms of the figures. Let's suppose the first thing they do is they pay their mortgage payment for the month, which is $1,013. And let's suppose they give $100 to the Lord's work. And then let's suppose they incur some expenses for food. And let's suppose it's $400. And let's suppose they now come up with an automobile repair, and it's $100. They pay that, and you can see as they disperse these expenses, and you should put them in according to the day. You can see the day each here. As they disperse these expenses, the balance automatically decreases over here. So this way you can keep track of how much money is in your joint checking account, so you don't spend more than you have there. For those expenses, for example, automobile repair, where we do have some funds in the savings account, you certainly should pay it from your checking account, but you can actually transfer money from your savings account to your checking account to cover this. And so to do that, you basically go to form number 4. And in form number 4, you'll see under automobile repairs, we do have $200 there. And so what you do is you key in a minus $100. And what that does there is it takes $100 out of this category. And you can see it automatically transfers that $100 over to the checking account. And by the way, don't forget to physically transfer the funds as well, either through the internet or ask the bank to transfer it when you're at the bank next time. But you see this $100 automatically comes here, and it increases, and it now is available for the automobile expense to cover that $100. Next, this couple, on the 8th day of the month, they had to make the payment on their personal line of credit, and, I meant on their credit card, and that was $500. And they made it on that day, and we've recorded that payment. They've also incurred, on the following day, entertainment and recreation expense of $150. And they also incurred some clothing expense of, let's say, $200. And basically what you do is you enter into the various types of expenses as they're incurred throughout the month. On the next day, they incurred some house expense. It was actually a house repair of $125. And again, if you recall, house repairs, we do have some money in the savings account that can cover that. So let's go over to the savings account form number 4. If we look under house maintenance, we do have $100. We don't have the full $125, but we do have $100. And so we can transfer that $100 from the savings account over to the checking account. And again, be sure to transfer it physically as well. Don't just transfer it on your form, but transfer the money physically between the bank accounts. And you can see as we do transfer this money, the balance in your savings account calculated here automatically gets reduced. And you'll see that $100 shows up on the 10th day of the month over on form number 6. And here it is there in order to cover this expense of $125. Now in that case, we didn't have the full amount available in the savings account, but at least we could cover the majority of that expense. And we only had to take effectively $25 out of our joint checking account. And this couple just continues to record their expenses as they're incurred. Let's suppose for house expense, on the next day they pay their hydro bill of $250. And a couple days later they pay their gas bill of $225. And then their water bill comes in and they pay $120 on that one. And then let's suppose after that their property tax bill comes in, and it's $550. Now again, if you remember, part of this property tax bill was covered and is available in form number 3 in the savings account. My apologies, it's form number 4 in the savings account. And because we do have some money available there, at least $275 worth on the property taxes, we can take those funds from an accounting perspective from the savings account and transfer it to the checking account. Again, remember to do that physically. And you do that by just simply entering a minus $275 there. And you can see this, the savings account balance comes down. You can also see that the designated funds get adjusted as well. We had $275 that we put in there at the beginning of the month, designated for property taxes. We've taken it out so there's nothing left. And again, you look down here, they have $967 in the savings account, and the full amount of the funds are designated for future purposes. So again, they still have no undesignated funds. So this couple should never think because they have money in their savings account that they can go spend some. All these funds are designated for future needs. So we'll go back now to form number 6, and this couple just continues to incur other expenses. Let's suppose on the automobile side they incur their gasoline bill, and they paid that of $300. And that they've incurred some other expenses, some more entertainment and recreation, perhaps $125. And then they've incurred some healthcare expenses, perhaps some chiropractic bills or something of that nature of $150. Their life insurance premium comes due, and they have to pay that. It's $100 a month. And miscellaneous, let's suppose they incur all their miscellaneous expense of $330 at one time in the month. Obviously, for most cases, they're going to incur that over several times in the month. And that's what form number 6 does. What it effectively does is it tracks your expenditures throughout the month. And often a couple or an individual have to do this, prepare this form for 3 or 4 or 5, 6 months to get a really good handle on where their money's going. And by the way, just tracking your expenditures can make you more conscientious of where you spend money, and often we find that the income, the spending rather, goes down. Now you'll see in this case we did keep track of the balance here, so they actually ran into an overdraft, and obviously the only way they're going to be able to fund that is if they have an overdraft privilege or a line of credit. I've assumed that they have that here. Again, it's not an ideal, but at least they have it. So what we have here, that's the end of form number 6. The idea is to track your expenditures. It is best to update this form every 2 or 3 days, and if you have to do some estimates sometimes, perhaps you took $100 out of the bank and you have $20 left in your wallet and you're not sure where the money went, at least allocate it to somewhere. Often people will allocate it into the miscellaneous categories. If you can track your expenditures within $100 per month, if you can track within $100 of what you're spending, you're doing much better than most. Form number 7 is the budget analysis form. On this form, you actually don't need to enter anything. All this does is it takes your present budget on form number 5 and your actual expenditures on form number 6, and it compares the two and lets you know whether you're over or under budget. Now, with this couple's particular situation, they are spending more than they're earning, even on their budget, so they obviously at some point have to go back and go through form number 5 and reduce some of their expenditures. But as you can see, their actual expenditures, as they're compared to their budgeted expenditures, it just shows you the overage and underages, and it just lets you know if you're spending more than your budget in a certain category, and sort of highlights it for you to deal with that.
That's it for the videos. I know there's a lot to absorb there, and it can be overwhelming for some of us who've never, put together a budget. And what I would recommend, if you haven't had any experience budgeting, I would just start with forms number 2, which is revenue. Essentially, you just want to know what your after-tax income is. Form number 3, which is the non-monthly recurring expenses. Remember, we talked about those, like the property tax and insurance and healthcare costs and stuff like that. And then form number 5, okay, which is your monthly budget. Because the objective is we want to get a handle on where our money's going, right? Want to try to get those expenses, and we want to really find out whether or not we're generating a monthly surplus or deficit. That's the key. The other forms are more for tracking purposes, and they're important, don't get me wrong, but I just don't want you to get overwhelmed, right? Because it's a lot there. As Eli mentioned, we're geeks and we get frustrated doing this stuff sometimes. So just think about the objectives, right? Right now, you want to find out where our money's going, so tracking our expenses, and most of those are on form number 5, right? And then determining whether or not we're generating a monthly surplus or deficit. And then you can start to make some decisions, right? Because we're going to have to make decisions, whether or not we have to, reduce or cut some expenditures to ensure that we get that monthly surplus that we need to pay off debts if we have them. And I'm sure most of us have some form of debt or another. Okay, so we'll stick around after. I know we're getting tight for time. If you guys have questions about this, but you can also go to the website and watch the video again. And there's, I think there's like a PDF, like an instruction as well there, so that's helpful. So just go to the website and you can look at it as many times as you like. Okay, so we're going to move on to our final session, which is dealing with inflation and high interest rates from a biblical perspective. So this is something that, unfortunately, all of us are kind of struggling with today. It's been kind of heaped upon us, and we're in very unusual economic times. Highest inflation rate in 4 decades, and interest rates that have skyrocketed in the past several months. And many people are struggling, are really struggling financially, just trying to make ends meet. And unfortunately, we talked about this earlier. When we violate a lot of these biblical principles that we've been talking about today, there's going to be a day when we're going to suffer for it. And unfortunately, like I said, a lot of people are suffering these days, and we hope that, it's not going to get to a point where a lot of people are going to lose their homes, but it may very well happen. If interest rates keep rising, there's a lot of people that aren't going to be able to afford their homes anymore. To Eli's point earlier, people talk about how much value they have in their homes and all that. Yeah, that's it. It's all on paper, and that's great, right? But many people are house rich, cash poor. It's all on paper, but you have to live daily, right? We need cash flow. It's not a liquid asset. And what's going to happen when a lot of these mortgages come due and interest rates go from anywhere from 2% up to who knows where, 5 or 6%, a lot of people won't be able to afford their homes and might have to make the very, very difficult decision to downsize. And, that's a tough one. That's almost like a last resort. The bright side is, however, there is a small percentage of individuals who have been following a lot of these principles that we've discussed today. And they won't be as negatively impacted by high interest rates for sure, because if you're not carrying debt, think about it. Who cares if interest rates are higher? Actually, it probably benefits you, because if interest rates are higher and you have savings, you're going to get most likely a better return on your savings, right? So it works in the opposite manner. If you have savings and interest rates are going up, you're going to generate a higher return. But for people that are holding debt, it's very detrimental, right? So since they followed God's admonition to develop some significant savings as well, it's much easier to handle the increased cost of living, right? Because we know everything costs more now, from groceries to gas. But if you have developed some savings, then you have a cushion there to be able to absorb these rising costs. And who knows? I guess the concern is, and eventually we hope that these prices are going to come down. But the question is, things. It seems to me like, as an example, I know I look at some lumber prices, like a 2x4 prior to COVID, or these increases with less than $3. I think some of you are in the construction industry here. Then it went up to somewhere like $10, and now I don't know, it's somewhere around $8. But that's a massive increase, and then it just comes down slightly, and we're supposed to, adjust to that. I don't think things are ever going to come down to the way they were. So we're going to have to absorb this increased, cost of living to a certain degree. It's highly unlikely it's going to come right back to the way things were. And that's the challenge, especially if we haven't generated any savings and we're still living from paycheck to paycheck. It's very, very difficult to adjust to that. Yes, so Matthew 7:24-25, Jesus said, "Therefore everyone who hears these words of mine and puts them into practice is like a wise man who built his house on the rock. The rain came down, the streams rose, and the winds blew and beat against the house, yet it did not fall, because it had its foundation on the rock." And that's what we want to try and establish. We want to build a solid financial foundation. So when these times hit us, and we can't predict when it's going to happen. Nobody could have predicted COVID. Nobody now could have predicted this rising inflation to this degree, and then add the interest costs on that to try and bring the inflation down. In the interim, it's a double shot, really, when you think about it. if we have that solid foundation, we'll be able to, get through the storm. But for those, Jesus also warns in 7:26-27, everyone who hears these words of mine and does not put them into practice is like a foolish man who built his house on the sand. The rain came down, the streams rose, and the winds blew and beat against the house, and it fell with a great crash. So Tom's just shared a few recommended steps to try and deal with the significantly high cost of living. And you'll notice a lot of the things that are in here we've kind of touched on before, because a lot of these principles are, when they're applied, they help to avoid this very situation, right? So the first, always go to the Lord in prayer and ask for wisdom and direction. We need spiritual discernment. Everybody's, financial challenge is unique. Some people may have to eliminate wants and desires, and that's tough for a lot of people, but, fortunately, these things are forced upon us, and sometimes we need times to get bad before we actually take action. When times are going good, unfortunately, we get into the mindset that we think the good times are going to last forever, and they usually don't. So if we learn to build up a surplus of cash, then, like I said, we'll be fine. It's those who unfortunately haven't done so are going to have to make some really difficult decisions. And if it's just a matter of eliminating wants and desires, that's not a big deal. The problem is if you have to start eliminating some needs, that's tough, right? So like some people might have to actually downsize their home. Others, if you're eliminating discretionary expenses, again, it's not so much of a big deal, but it's more when you have to start cutting into your needs. Okay, number 2, determine your financial position. We talked about that earlier, so that's really about your, in this case, your debts, right? Your liabilities. You really want to get a handle on what are your outstanding debts and what is the interest rate that's associated with that date, and what's the maturity, because you want to know if you have a mortgage, you want to know when that mortgage comes due, because if you probably have a very good interest rate right now and your mortgage is going to come due within the next year or so, the interest rate's going to go up significantly. So you want to be able to project, if you're going to project your future cash flow, to determine if you're going to be able to absorb that increase in the interest rate, so you can, continue to just pay that mortgage. Number 3, sell any unnecessary assets in order to pay down debt. That's a very good idea. You can always do that as well, just to generate some further income to pay off your debt. Number 4, determine where you've been spending money. Suggest, recording all of your expenses for the past 6 months. And I kind of mentioned that earlier, but so you can get a fairly good understanding of what your monthly expenditures are. We need to know where we're spending our money and whether we're generating that surplus or deficit every month. Number 5, review normal monthly expenses and eliminate any discretionary expenses. That's the easiest place to start, right? Our wants and desires. We have to just accept that. And if you have a positive cash flow, you should be able to continue with the current lifestyle, excluding discretionary expenses. Number 6, if after eliminating unnecessary expenses you have a deficit as your projected budget, then you need to either increase your income or do some significant downsizing. Okay. And number 7, we touched on this. For those who are making ends meet, it's going to be a struggle, but hey, there's options out there, right? I mean, there are ways of generating more income, and we just have to look at creative ways of trying to cut our expenditures. And it comes back to I mentioned earlier that an old client of mine mentioned, we have to learn to live slightly below our means. Ideally, it's nice to do that when you're not forced to do it, right? That's the point he was trying to get at. If you do that when you're not forced to do it, you can do it gradually, right? But in these types of situations where it's being imposed on us, right? We have to make drastic decisions. And sometimes something good comes out of that. Maybe we will learn to be content with less, and it'll just benefit us in the future. So try and take something positive out of it. learn to be content. That goes without saying. I think we've touched on that a lot today. Cost of living, mortgage payments are increasing faster than people's salaries. Most people will have to learn to be content with less materially. Okay, I'm just going to move on here. Financial temptations. I did mention this, I think, a little bit earlier about the spiritual battle going on constantly, and I think it's important for us to realize where we are tempted. All of us are different, right? It might be, for some guys, it might be, kicking the tires at the dealership, and for someone else, it might just be going to the shopping mall. We just have to acknowledge we have these temptations, and we need to, at least we can acknowledge it, and then we can learn to resist it, right? Pray and ask the Lord to reveal our areas of financial temptation. And I think if we're honest with ourselves, I think we know where we're tempted. If not, you can always ask your spouse or a trusted friend. And great place to look is your credit card and bank statements. We can see where we're spending our money, and you always ask the question, is this a want, or is this just is it a want, or is it a need? Sorry. Okay, and in order to avoid the areas of financial temptation, Paul mentioned, no temptation has overtaken you except what is common to man, and God is faithful. He will not let you be tempted beyond what you can bear. Right? But when you are tempted, He will provide a way out so you can stand up under it. Okay, I'm just going to move on for the sake of time here, and dealing with higher interest rates. So in Canada, just some stats here, Tom has pulled up. A typical 5-year fixed mortgage, so like a fixed rate mortgage, in December of 2021 was about 2%. Today it has increased to 6% and heading higher. Similarly, interest rates on variable mortgages, have gone from approximately 1.5% to about 5%. So those who are in variable rate mortgages are being impacted right now because their interest rate fluctuates as the bank, raises the rates, and then the bank prime rates increase. So those people are being affected right now. Their mortgage rates are going from, roughly 1.5% to 5%. Those who are in fixed rate mortgages, they've been locked in. It all depends on when those mortgages come due, but it's probably fair to say anything that'll probably come due within the next year is going to experience a much higher interest rate than what they previously were paying. So it's important to anticipate that if we're holding fixed rate mortgages, like we have to anticipate that we're going to have to pay a higher mortgage payment, and we have to make sure that we have enough funds to support that, because we don't have to, we don't want to have to make that decision again to sell or, to downsize. Assuming a 25-year amortization, most people's mortgage payments are going to increase anywhere from 20 to about 50% based on the current rates. I mean, that's significant. A lot of people won't be able to handle a hit of that magnitude, right? And as Tom mentioned here, given that most people spend all their regular income and have no savings, no cushion within their monthly cash flow, many people will be forced to downsize their homes, unfortunately. Okay. I think Eli maybe we'll just move on to the next slide. I don't think we need to answer this question here. Yeah, I'll let you continue. Next one.
Okay, so we look at just thinking this through, some examples of what can happen when the mortgage payments increase substantially. And I'm going to sort of give you some numbers in a minute or two, but many people, unfortunately ignoring the negative impact on their monthly cash flow from larger mortgage payments, and these kinds of things are not really being taken into account, especially with those on variables, or maybe even those like Tony was alluding to, where they're facing a reset of their fixed rate mortgage in the next year or two, right? This could result in some serious financial consequences. When the mortgage comes due and the new payment is significantly higher, there may be cases when some no longer qualify for the current level of financing. So that might be a little more rare cases, but it's quite possible depending on the bank. Okay, so the idea is to be proactive. Okay, plan ahead. The mortgage is very likely the biggest expense, biggest obligation you'll ever have. Be proactive on this. Look ahead, see what kind of rates there are in terms you can get from different institutions. Develop a cash flow plan to see if you can afford the higher payments. What capacity do you have to meet higher payments? So, I mean, downsizing, that might be in the cards. We hope that's a last resort, and ideally that's a last resort. But you might have to, if it comes to that, if the situation is dire enough to push comes to shove, might have to consider doing that. Okay, so like I said, I had some numbers I wanted to share. I know it's been a long day. Maybe we're getting a little sleepy. Maybe a little weary. A lot of information. I totally get it. So I wanted to share a few numbers that might help wake you up if you are, sort of tuning out a little bit, because just some things that I found. I crunched some numbers when we're looking at mortgage rates and the assumptions that go into mortgage rates. So I want to just give you some basic assumptions. Okay, now this might be high, low, whatever, based on your experience or your situation or what you're seeing, but I think they're reasonable assumptions, what we're seeing out there. Okay, so let's think of just hypothetical, and I want to get your feedback. Just some guesses, there's no right or wrong answers. Think of a $500,000 mortgage. Okay, so somebody, looking to get a house, maybe it's $600,000 or $700,000. Okay, maybe I'm way off. Maybe that's not what the price will be around here. But let's just, for argument's sake, let's say $600,000 home. Someone's going to aim for roughly 20% down payment. That's pretty good. So let's say a $500,000 mortgage. Okay, I'll give you. Well, I want to make this very simple. $500,000 mortgage. We're going to pay $2,500 a month. We want to keep that fixed permanently until the mortgage is fully amortized. So I'm going to give you, now the assumptions will change with the interest rate, okay? So in the world we were living in, just around a year ago, you're getting 2%. Okay, so let's just say, hypothetically, you're not getting that now on a new mortgage, but let's say the interest rate is 2%. I like to look at, running these numbers, what is the total amount I'd end up paying for this house? Or, okay, forget the down payment, but what will be the total amount of money I end up paying? Any guesses out there? The mortgage is $500,000. I'm paying $2,500. I'll tell you, it'll take 20 years, and the interest rate is 2%. What is the total amount? Any guesses? Okay, you guys are a little higher than I thought, but it's okay. So the total it's okay. No, the total you'd end up paying is $600,000 over 20 years. But we need to keep in mind that 2%. That's okay. 2% is you'll see why I'm going through this exercise in a minute. 2% is very, very unlikely going to come back again for any of us in this room. I hope I'm wrong, but I don't think so. So that's sort of our baseline. Let's think. So you're probably paying a little over $600,000 total. If you were $500,000 principal, 20 years, $2,500 a month. Let's increase the interest rate to 3%. Now what's the total going to be? I told you it's about over $600 for 2%. That never changed. Let's assume the interest rate's 3% average, just for simplicity. What's the total you're going to end up paying? $650. Okay, good. Any other guesses? You'd be paying a little over $700,000 over 23 years. Okay? Let's increase the average interest rate to 4%. Now we're getting closer to the current reality here. Any guesses now? A little over 800, so this has gone up incrementally about 100, a little over 800 over 28 years. assuming everything else stays the same. And now we're getting even closer to the current reality, 5%. What will you end up paying if everything else stays the same for that house? Yeah, over $1 million. Very good. Over $1 million, closer to 1.1 million, right? So I just say this to impress upon you, again, what's happening, right? And where's all this extra money going? I mean, Tony mentioned it's going to the bank. That's exactly where it's going. And we need, I think it's just worthwhile to think about stuff like this, right? And it's easy to lose sight of this. Because we've been in a low interest rate environment for many years, maybe a good chunk of our lives. But B, we look at it like in this 5% example, if you didn't change anything else, you'd pay it off over 36 years, right? And it's hard to visualize decades ahead. But I tell you to think about it this way, right? Like you end up paying over $1 million for a house, and you paid over more than the amount you borrowed. You end up paying to the bank. Think about what you could do. So many better purposes for that money than giving it to the bank. Now, I get it. We have mortgages, and it's difficult, and it's going to take time to pay it off. I totally get that, but that's a lot of money. We forked over $500,000-$600,000 of extra money to the bank over 30, 35 years, 36 years. You can imagine, we have a wonderful church here. There's many other wonderful churches. There's kingdom work going on all over the world. Imagine how much better that money can be spent than sending it to the bank, right? Imagine just helping people you love, supporting your family, people that could really need it, just doing God's work instead of giving that money to the bank, or just saving that money for just better purposes, right? So I just wanted to, have some fun with numbers, but just impress upon you how this all works, right? And that's just assuming nothing else changes, right? So we want to make, paying off the mortgage there on the bottom there, a priority, right? Now, go back to the top, Ephesians. Be very careful then how you live, not as unwise, but as wise. So just going back to everything, all the principles we learned, right? Like God just clearly discourages the debt. It's not a sin to borrow. It's not a sin to be in debt. But this is precisely why I've laid out the numbers, right? They didn't have numbers and spreadsheets back then, but God knows. He never changes. He understands what's good for us and what's not, right? So we don't want to be foolish. Do not be foolish, but understand what the Lord's will is. So paying off the mortgage is an excellent way to save money in the long run. Okay, and that's why I just, really want to implore everybody to make that a priority. And most people just sort of, I'll just keep the payments the same. You just kind of ignore it. And I've even heard some, economists and economic, commentators mention, in a high inflation environment, it's okay to, having extra debt is not the end of the world because the money that you're going to have to pay back, it's going to be worth less, right? That's economic principles. That's not godly. That's not godly principles, right? So just keep that in mind, right? Like you could pay, double up your payments, paying lump sums, right? However that may happen. I was talking to somebody about, getting government money, and I've been trying to do this. I've been getting government subsidies from COVID. Thank you very much against the mortgage, right? Like, just little things like that. They can really add up on a weekly or bi-weekly basis. The more frequently you can do things like that, the better. Okay, so just whatever you choose to do, have a plan and make sure you can handle the increased payments. Okay? Yeah, we want to shop around for the lowest payment terms, and the banks will have their posted rates, but those can likely be improved upon if you shop around. Okay, especially if you have a good credit rating. Okay, so that's, we look at, we want to tackle the biggest item that can really help us reduce our debt, and what we believe is a very high priority. But there's definitely other things you can do, ideas to reduce expenses. other things at the margin that you could just do little by little every day, every week. Turning off the lights, try to, when you don't need them, do the chores, use the electricity in off hours. Pay your credit card balance in full each month. I learned the hard way 1 month, okay? It's just so unnecessary to be handing over Visa or the bank interest charges for things like that. And, dining out, yeah, no offense to anybody that makes their living in this industry, but it's just some of these prices that are charged at some of these places, I find it unbelievable sometimes. I mean, some places are reasonable, but some places are just clearly not. And the prices have really been marked up the last couple of years especially. And not that I go out a lot, but a few odd places I've been to over the last couple of years, I've really noticed that. So I find it helpful to cut that down, and even coffees and things like that we take for granted. Yeah, vacations, replacing vacations with staycations. Vacations can certainly add up, can take a toll on our bank account. We talked about this as well, gym memberships, that came up, clothing. Just a lot of these kind of retail things, expenses that we don't maybe always give much thought to. They can definitely be highly marked up and can be replaced in a reasonable way. Okay, so I won't go into all these details. Education, this is important. Do want to make a stop here for a minute. Saving early for children's education. This is extremely important. You're not going to get, the government's going to kick in 20% up to a maximum of $7,200. You're not going to get 20% guarantee return anywhere, right? So this is really important. Take advantage of this, the Canada Education Savings Grant. I highly recommend that to anybody with kids or thinking about having kids. Get this on the radar and start doing this as soon as possible. Definitely biblical to save for children's education, planning ahead. You might think, it's 15, 20 years ahead. The time will be there sooner than you know it. I have an 18-year-old now, and the time has come, and I'm not sure where the years went by. So I can tell you out of experience, do it early and often. And teaching them as well, that's a valuable thing. Like as you're doing these things, you can teach them, right? Save a portion for the Lord's work. Save a portion for longer-term savings, short-term savings. Because if not, what are they going to do? Likely just get into the worldly mindset. I'm convinced that if we don't take the time to make this teaching, this training a priority, just gravitate towards social media, friends, and other influences that are not preaching on the things we've talked about here. Yeah, Christmas gifts, this can be very expensive. This can be very, very expensive if we're not careful. But a good way to cut down these kinds of expenses, maybe you can discuss with family what are reasonable expectations. The other thing is buying them throughout the year. If you're going in December, a couple weeks before Christmas, it's probably not the best time in terms of prices that you'll get for a lot of these gifts. So that's something to think about, and in heating costs as well. Some people maybe can handle that better than others. Some people get colder than others, so I understand that. But if much you can bear, maybe reducing the temperature a little bit, wearing some extra clothing could be an option. Yeah, and swapping services. We've seen people do that at our church a little bit here or there. Somebody might know how to fix cars. Somebody might know how to fix flooring, things in the house. You can swap and barter services. Just be careful if you get into doing stuff like that. You can do it with somebody trustworthy. Okay. So we're nearing the end. I do want to just take a few more minutes. We're we're very close to the end, but I think I want to impress upon the point, that the hardest part to accomplishing all this, to getting our finances in order, is learning to be content with less. So we highlight that. Learning to be content with less. Contentment, one of the key foundational principles. Okay, so when an individual or couple learns to be content, and then we follow that through on building the budget, to ensure a surplus each month, to pay down debt and save for future needs, then you can be able to deal with unexpected expenditures, deal with high interest rates, deal with inflation, just all these extra costs, these higher living costs. Okay? But we're just going to go back and sort of close the loop on everything, right? Like we said in the beginning, contentment's the key. But to be content, we need to have a humble heart. We need to desire to be a steward and give up what we have and realize that what we have is not really ours, and we're going to steward it. And that requires a great deal of humility. But I've also learned that it's difficult to be humble. I've had that challenge. It's difficult to be humble. It's much easier to be prideful, especially when my perspective is wrong, when my perspective is out of line with reality. And if I don't have that eternal perspective, then the rest is very, very difficult and very challenging, right? And so I just want to take a couple of minutes here. We don't know in a group like this or who's online and who's watching, right? Could be that everybody has a personal relationship with the Lord, but in our experience, that's not necessarily always the case, right? But we believe this is important basically because if you don't have a close personal relationship with the Lord, all this stuff we've been talking about, this eternal perspective and humility and contentment and these spiritual issues that are holding us back, it's just not going to make a lot of sense, and it's going to be difficult to follow through. You can follow through a little bit and try to balance your budget and cut back, but it's very, very difficult if you just don't have that close personal relationship with the Lord. And whatever the situation is here is even if it's we think of the parable of the lost sheep, right? We will take a couple minutes to leave the 99 and just focus on the one. If there's even one person watching or witnessing this that just doesn't have this or doesn't get this or doesn't understand, I think it's worthwhile to do this. So I appreciate you bear with me. Like if you don't have that personal relationship with God, God's word, the Bible directs you as follows. God loves you and God wants a personal relationship with you. Jesus said, I am the good shepherd. I know my sheep, and my sheep know me just as the Father knows me, and I know the Father. But we have this sin problem, and it's separated us from God, as shown in Romans 3:23. For all have sinned and fall short of the glory of God. And then we have it diagrammatically, looks like that, this separation between man and God from sin. Yeah, so many people seek God the wrong way. I apologize, should have had this. I know, many people seek God the wrong way. Tom has mentioned morality as something that sort of got in his way many years ago. For me, I'd say it's more religion, maybe kind of good works was something. I grew up more in a Catholic church, but wasn't that committed. But I was just thinking, okay, I've been baptized and confirmed and had communion enough, and that's good enough for God, right? So just from Proverbs 14, there's a way that seems right to a man, but in the end it leads to death. Okay, spiritual death. And so we see these things like good works and religion, which I've mentioned, philosophy, morality. That's, they're just these different things that we try to reach God with, but they just don't work. None of our efforts can bridge this gap. Okay, there's really only one solution. And the solution comes in the form of Jesus Christ. He answered, I am the way and the truth and the life, and no one comes to the Father except through me. So God demonstrates, that's John 14:6, God demonstrates his own love for us in this: while we were still sinners, Christ died for us. And so the diagram looks like that. Christ bridging the gap between us and God. We'll never ever be able to get to God without Jesus. So we must make the choice. Can we admit that we've sinned? Romans 3:23. Be willing to turn from our sins and obey God. So are we willing to be humble and admit we fall short? Believe that Christ died for you. Accept Christ as your Savior. For God so loved the world that he gave his one and only Son, that whoever believes in him shall not perish but have eternal life. Okay, so we're just, we want to, in prayer, if you've never accepted this or believed this or, thought about any of this, we just really encourage you to do that now or later. Invite Christ to come in and control your life through his Holy Spirit. Accept him as Lord. Here I am, Revelation 3:20. I stand at the door and knock. If anyone hears my voice and opens the door, I will come in and eat with him and he with me. So it's a simple prayer. It's that we like to share. It's, Dear God, I know that I am a sinner and I need your forgiveness. I believe that Jesus Christ died for my sins. I am willing to turn from my sins. I now invite Jesus to come into my heart and life as my personal Savior. And lastly, I'm willing by God's strength to follow and obey Jesus Christ as the Lord of my life. These are some of God's promises. Yet to all who received him, to those who believed in his name, he gave the right to become children of God, children born not of natural descent, nor of human decision or husband's will, but born of God. So if you've accepted Christ as your Savior and Lord, you're a child of God, and you have the privilege of enjoying a personal relationship with God. So this is, we didn't want to just neglect that. Like, this is something, it's important, and in all these events, there's always, potentially at least somebody that just has not followed the Lord or taken that step of obedience. And we know that to follow these principles, to follow the things that God has laid out for us in terms of how we ought to manage money and material things, it really can't be done, in all honesty, without a close personal relationship with him. So the other thing I just want to mention, as we close and we just think of these foundational principles, an eternal perspective, to give us the humility and the contentment in order to persevere and be debt-free, and not allow our finances to control us. Like we heard a good analogy downstairs at lunch. We don't want the finances to control us. We want to be able to control our finances, but we do that with God's help and grace, right? So, our prayer is that, this is great, and we're thrilled that everybody's here, that you would follow up. We don't want this just to be, a Saturday here, and then you got the material, and off it goes to the side, and that's it, right? Like, it really, for this to all work, and to really truly benefit you as God desires, it really requires some follow-up. We do have, I'm not sure if we still have the resource table at the back. Tom has, just as mentioned, we had a bunch of resources Peter mentioned in the beginning. Definitely, if you don't have any and you're willing to go through it, Tom desires twice, once to just kind of understand it, and then twice to actually make sure you're following through. We definitely welcome anybody to take anything that they believe might help. That's free of charge from Tom's ministry. Okay, and that's what we encourage, right? Like, if you want to follow up, take some resources. You can get in touch with us. I think Peter, we didn't share our email, but Peter has our email. You can always get in touch with Tom at the ministry as well. And I think that's about it, unless you have any other closing comments. I can just pray, or is there any questions or anything? We can all, Tony and I will be around. We can chat with anybody that wants to hang around, but any last things? I'd say probably the bank is fine. Like, I mean, okay, you possibly go to a third party, and maybe to be honest, I haven't shopped around for that. I mean, you might be able to go to a third party, maybe get some lower fees. Might be a little riskier. I don't know. I mean, the banks manage their funds. You know, it's pretty. I'd probably say pretty generic, like TD versus RBC versus CIBC. I think the more important than that is, okay, I mean, to answer your question directly, you probably can get some lower fees if you go to some other institution. I can't tell you for sure. But the one thing you just want to ensure that you do, whether it's with a bank or not, is just really have a good handle on, okay, if you got 20 years, it's fine. Then once you get to 10 years away, when is the beneficiary going to be starting? And make sure you're really on top of the risk profile of those RESPs, right? Like I've seen in, my line of work, there's just some inappropriately aggressive investments for 14, 15-year-olds, and they're going to be starting university in 2-3 years, right? And so really when you got to be on top of when you're going to need that money, and the banks might not always alert you like, oh, okay, it's time to get more conservative, right? So, but specifically on your question is it's probably worthwhile maybe to see if you can get some lower fees away from a bank. Probably wouldn't hurt, but I wouldn't know specifics. Yeah. Oh, okay. That's interesting. Yeah. Yeah. That's interesting. Yeah. I mean, I think at the bottom line is, yeah, you go with another institution, just have a reasonable sense of what they're investing in. Like, that's all I'd say, right? Like if you can't understand it at all, then I wouldn't recommend. You don't have to have a great understanding, but have a reasonable understanding of the major holdings in those funds that they'll put it in. So yeah, that's a good point. Sure. Yeah. Okay. Yeah. No, that's a great question. Like I'm in, like me personally, I get letters all the time, like several times a year, telling me I'm pre-approved for double or triple the capacity current limit on my credit card. I believe that just as a total safeguard, just to keep it no more than your net monthly income, so husband and wife, or just one person, whatever it is, right? Net household income, I would just keep it no more than that. Just if you're not going to bring in enough on a monthly basis to potentially be able to pay it off, like even you might say, well, I'm not going to go up to the limit. Things happen, stuff happens, and you just don't know, right? So I just, as a safeguard, like I get constant requests and pre-authorized, you're double, triple, but I just completely ignore them. So I could have done it many years ago, but it's no need. So that's sort of my thought. I don't know if you have any other ideas. Yeah.
No.
pay for everything yourself. So you don't need to worry about that.
Yeah,
22 buying a house with cash in your drawer.
it's a fair point.
Yeah,
Yeah, go ahead.
I think, you raise a good point because I used to work in the banking industry, and your credit score is very important, right? Because let's be honest, we can't function in society today without credit cards. And absolutely, it's very important to build a strong credit score, especially if you're planning on purchasing a home someday, right? Because it's going to impact how much you can borrow, what the rate might be. It's very important, right? So yeah, I think to your point, definitely have a credit card, one or two, whatever, and just be conservative with it. Like to your point, have a reasonable limit, and just try and build it. The key is, I forgot to mention earlier, with respect to credit score, if you're 1 day late on your payment, it'll show up on your credit score. So make sure you pay your credit cards on time. That's another reason to pay them off on time. Not just you don't want to incur the interest. That's the big one. But you also don't want to get a hit against your credit score, and that's important too. And that goes for any, like if you have a loan, because they all show up right on your credit report. Make sure you make your payments on time. That's the key. And I didn't find that out until I actually worked for the bank. Like if you're 1 day late, it'll show up as a hit, and you don't want that. The other thing is, the reason I say try and only have one, I say one. If you have to have two, that's fine. I get it. You have different cards that you get different benefits from. But the more credit, let's say vehicles you have, like the more credit cards you have, the more loans, that reduces your credit score. You know what I'm saying? Because banks tend to look at people who have a lot of credit available to them as credit seekers, and they're higher risk, right? Because you may not have like to your point, you might have a limit on your card, and you might not use it, right? So you say, hey, I'm not using it, I'm responsible. But the thing is, it's available to you, right? So you can go out tomorrow and just jack that right up, whether it's a line of credit, whether it's a credit card or whatnot. So that's something else just to keep in mind. Try and even for your own sanity, right? Like when you're trying to do this budgeting and stuff, the more you can consolidate stuff, the better, right? The more, like Eli mentioned it, like the more stuff you have going through your accounts, it just gets overwhelming. If you can try and just consolidate stuff, like I said, if you can just have a few credit cards and hopefully, other than that, just a mortgage, that's ideal. You might have a car loan or lease, but it gets to be overwhelming. It gets to be a burden trying to manage this stuff the more you have to deal with, right? Not to mention the temptation and the potential interest costs, right? Yeah. Oh, sorry there.
I have a challenge for people. I'm a firm believer in if you don't have the money for it, you can't afford it. House being the only acceptable debt. And back to the credit score, a lot of people preach on good credit scores. I believe that to be complete garbage. But a couple years ago, this is just a personal story. I have an amazing credit score. I don't know what the highest is. I'm just below the highest. I'll brag. When I went self-employed. When I went for a mortgage, they denied me. But I have an extremely high credit score.
Yeah.
Why?
That's
They said because I'm risky. Look at my history. I make all my payments on time.
Yeah.
If not before. I pay more than I have to. So then at that point, that's when I realized my credit score is like it doesn't. It's your relationship with debt. And
Yeah.
here we're talking about debt from a biblical standpoint is not good. But then we're kind of preaching here that good credit scores, that's important. But it's like it's almost contradicting. You know what I mean? So I'm just
Yeah.
trying to challenge people.
Yeah.
I understand we can't buy houses in cash, but we can buy vehicles. I
Right.
get it, and I know people that have done it.
Yeah. You raise a good point, and I'll be honest with you, it's one of the reasons I kind of got frustrated and left the bank, because I worked in small business, right? And it was so frustrating. I would see people that were very successful in business and accumulated significant like equity, like we talked about, net worth, right? But because they're small business owners, and the banks look at them as higher risk simply because the income fluctuates, right? It's not like if you're employed somewhere, you have a salary and it's pretty stable over time, right? For small businesses, people who are self-employed, unless you have a good history that you can go back and look at, then that was my experience. It was very difficult because you have to check so many boxes, right? it's credit score is one of the boxes, right? Then you have to have the income to be able to support whatever you want to borrow, per se. So I share your frustration. I know it was very frustrating on my end because I guess having a finance background, I'm saying the same thing. Can't you see that this person is financially sound? Like they know what they're doing? But unfortunately, banks have their lending criteria, and unfortunately, it doesn't really favor small business or self-employed people. And it's really unfortunate because sometimes they have to go to secondary lenders, and they charge more, a little bit higher interest rate. But to your point, point taken, but credit score still is important if, again, if you're going to try and get a mortgage, generally speaking, and, if you're self-employed, it might be more challenging. But it's still a box that needs to be ticked, I guess, if you're going through a traditional lending institution. That's my point.
I eventually did get a mortgage
Yeah.
after haggling with them for a little bit.
Yeah.
But I was labeled high risk. I can't get a 25-year mortgage. I
Really?
have to go with 30 years. They only give me 30 years, and I pay 0.5% more than everybody else.
Really? Yeah. Yeah.
And I've gone to multiple lenders, mortgage brokers. That's what they all say. It's because I'm within 3 years of starting a business.
That's right. That's right. Yeah.
But it frustrated me because I do have a really good credit score, and that's kind of where I said, well, what's the point of me? I work hard, pay off my credit card, and I'm just like, if it's not benefiting me, what's the point of having it?
Yeah.
I'm actually against credit cards. So
Hey, if you can get by without them, all the power to you. Right? Good. Thanks.
Same, both Carl's and Jake's question. In Canada, can you get a mortgage without a credit score? Since you were in the banking industry, I know in the U.S. you can. It's called manual underwriting.
Yeah.
I don't know if that's possible in Canada.
To be honest with you, it's been a long time since I worked in the banking industry, but I don't know if you know, Eli, but
I'm sorry.
I think it'd be
don't
tough.
know.
I think it would. I don't. Yeah, that's a good.
Security for the bank, they're going to say, well, we're crazy not to lend this guy maybe $200,000. We're not giving him any more because the house is worth 500 and he has 300. There's enough security there that if he defaults, I mean, hey,
Yeah.
$500,000 house.
But I think the reality, and let's face it, today, like how many people struggle just to come up with 20% to put down, right? So if you're putting down 20% and you don't have a credit history, it's kind of hard to lend on, I don't know, average. I know in Toronto you can't buy a house for less than $1 million. Here it might be less, but it's still significant, whatever it is, right? We're borrowing large amounts of money. So I think it'd be very, very challenging to be able to get a mortgage without having some sort of credit history, right? Because that's really what your credit score is, right? So, we have to deal with reality. It's, and all we have to do is exactly what we've been talking about today. No problem. Get a credit card, get two. Just use it wisely. Use it to your advantage, right?
For myself, by nature, I'm a spender.
Yeah.
So credit card, you're playing with fire. And it's very
Yeah.
right? Not saying it's not possible, it's hard.
Right. Yeah. Well, then just take some precautions, like Eli said. Just lower your limit to what works with your financial situation, just so you can build up that credit history, right? So it's there when they need it. But yeah, you have to just limit that temptation, right?
Yeah,
Something that I've encouraged young people that want to establish a credit score and they have a credit card is to do is everybody has a cell phone. So you automatically pay your credit card. You pay your cell phone with your credit card.
Yep.
And have an automatic payment going on your checking account to your credit card and stop carrying the credit card if you're
Yeah.
concerned you're going to use it and not pay it. That way your cell phone gets paid automatically, so you're establishing a credit there.
Yep.
And your credit card gets paid. You don't have to do anything for that because it happens automatically.
Yeah.
And you're building credit in two different areas.
That's a good point. Yeah.
Don't carry the credit card and never use it.
Right.
Don't memorize it either.
Yeah, no, that's very interesting. It's good to come up with creative things like that. The bank, just always keep in mind, the bank doesn't care. Their objective is just to maximize the interest rate spreads. That's how they make the billions and billions of dollars of profits, right? They don't care really. I mean, okay, they will reject some people based on credit scores, I guess, but like they're not interested in how we manage our visas and things like that, right? So just doing creative things like that is perfect, right? Because nobody at the bank is going to tell you to do stuff like that.
Your slide showed that you can pay 20% extra on your mortgage. Isn't it only 10 in our area or Ontario or Canada? I was told 10 by the bank.
It's yeah. I think most are 20. Yeah, they might vary somewhat, but I think most are 20.
Yeah.
Yeah, and that's and you can also double up. Most, I think, banks, you can double up on your payments, which is a good thing to do as well, because I know sometimes it's hard to save and make a balloon payment at the end of the year. If you can again incorporate it into your budget, even if it's an extra few $100s a payment, it helps big time, right? You'll see it over the long run. It's a lot of money. You know.
We were actually encouraged to do that on we forgot our first mortgage years ago. The bank, the lady at the credit union in town, she actually encouraged us to, she goes, your payment's only going to change by this much if you add 10% extra to every payment
Yeah.
automatically.
Right.
And it cut our mortgage down from 25 years to 18 years
Right.
right away.
And you saved a lot of interest.
A lot of money, I think.
Yeah, for sure.
Yeah. Excellent.
Yeah.
I was surprised to hear that from bank.
I know.
Her boss probably wasn't thrilled that she's giving this advice, but we took it.
Yeah, it's good. Absolutely.
No, I love it.
Anybody else? Oh, there's one there.
So the question is there a point where it's better to be in a TFSA versus RRSP? I would say if you, I mean, generally speaking, if TFSA is not going to be taxed on withdrawals, I mean, if the shorter term investments, anything shorter term, it's definitely more optimal to be in a TFSA. I mean, if we're just talking about purely retirement savings or very, very long-term savings, it's tricky to give you an answer exactly, but anything less than whatever, 15, 20 years, or whatever point you're going to take it during retirement, I'd definitely go with a TFSA if you haven't maxed it out. But it does become a little more complicated making the comparison, like if you're just comparing long-term retirement savings, better to be in a TFSA or RSP. It's different scenarios. There isn't a real clear-cut answer in that regard that I could give you right now.
Yeah, I think with the RSP, you got to think long-term, right? Because you don't want to be withdrawing from that because then you don't get the advantage, right? You're going to get taxed at a higher interest rate. Ideally, with the RSP, you want to wait to cash that out when you're retired and you have a lower income, so you don't get taxed as much, right?
Yeah, you don't want to incur any withholding taxes.
Right.
The 10%.
And it's a deduction when you make your contributions every year, so it helps to, reduce your kind of taxable income.
Yeah.
All right.
Okay. How about I just close us off in prayer, Peter? Is that okay, or anything else? Okay. All right. Dear Lord, Heavenly Father, we just give you all the praise, thanks, and glory to you alone, O Lord. You've made this possible, and it's not that anything we've done. We thank you for this material and for your word, most importantly, what your word has to say on finances and how we ought to manage everything you've given us, Lord. Pray that you would just impress upon our hearts some of these things we've learned today, Lord. How to have an eternal perspective, how to be humble, how to be content, Lord. And if we're struggling with any of these areas, Lord, how to persevere, to maintain a budget, and to persevere with reducing our debt. I pray that you would just give us strength and wisdom and understanding. Help us not grow weary, Lord, but help us just to do whatever it is you want us to do, just to manage money your way, so that it may not be a burden, but it may be a blessing, and that we may be in a better position to just serve you with everything we have, Lord, everything you've blessed us with. Help us to serve you all the more. I just praise you and thank you for everybody here, for all the interest in this area and the questions and the comments, Lord. thank you for this church and just putting everyone here at this time, and for the leadership, Lord. I just pray that you just allow everyone here just to follow through in some way, and just to take this and use it to help them, and I pray that others can be helped and ministered to as well, Lord. I just pray for everybody here for safety as we leave this afternoon. Not sure how the conditions are with the roads, but I just pray that you just keep everyone safe, and just praise you and thank you and give you all praise, glory, and honor. Pray all these things in your holy and precious name of Jesus Christ our Lord. Amen. Thanks a lot, everybody. Appreciate it.